The faint hiss of ticker tape machines, the roar of trading floors, the sudden plunge of stock prices. These are echoes. But whose echoes? Not just of Wall Street in 1929, but of something alive today. Something that haunts our markets, our policies, our fears. We begin in late autumn 1929. The air in New York is electric. Stocks have soared for years. Ordinary Americans, not just tycoons, are drawn into the frenzy. Brokers greet clients in department stores. Promises of easy gains lie everywhere. But underneath, cracks are widening. Credit is stretched. Banks are exposed. Confidence is fragile. On October 24th, Black Thursday, panic grips the market. Selling overwhelms buying. The plunge accelerates. On October 29th, Black Tuesday, it all comes apart. Billions of dollars in value vanish in a single day. The crash is not just a financial event, it is a psychological rupture. Trust is broken. Credit freezes. Banks fail. Business is shut. Families lose savings, homes, livelihoods. That collapse ushers in the Great Depression, a decade of despair. National output declines by nearly 1/3. Unemployment soars. In 1933, 1 in 4 Americans are out of work. Farms foreclose, dust storms scour the plains, cities suffocate in breadlines and hardship. The world economy, tied together more tightly than ever, convulses. Trade falls by over 50%. Entire nations teeter. The rules of capitalism, it seems, have failed. Yet out of tragedy, new institutions emerge. Deposit insurance, stricter banking regulation, oversight of securities markets, social safety nets. The scars of 1929 reshaped the financial architecture for generations. Today, we live in a different world, yet in many ways, history is circling back. A warning in the present in 2025, markets reach new highs. Valuations stretch. Technologies like artificial intelligence, blockchain, biotech attract fervent capital. Public discourse is full of terms like exponential growth, disruption, unicorns, democratized finance. Retail investors in millions buy into private markets. Meme stocks leverage derivatives. Regulation is under pressure. Some safeguards are weakened or rolled back. A cultural myth grows. We live in a perpetually expanding money machine. Journalist Andrew Ross Sorkin, in his new book, 1929, draws chilling parallels between the late Roaring Twenties and today's era of financial exuberance. Investopedia +3, The New Yorker +3 Business Insider +3. He highlights 3 recurring patterns: overvaluation of new technologies, then it was radio, autos, electricity. Now it's AI, machine learning, biotech. Democratization of risky investing. Ordinary people are drawn into speculative markets via apps. Zero commission trading and platforms promising access. Regulatory rollback. Oversight loosens. Guardrails erode. Disclosure demands weaken. He warns, a crash is coming. I just can't tell you when, and I can't tell you how deep. Investopedia +1, compare this to the behavior before 1929. Banks lent freely for stock speculation. Investors bought on margin, putting down only 10% and borrowing the rest. CBS News +2, The New Yorker +2. Ordinary Americans, unaware of risk, were drawn in with promises of easy credit and infinite upside. Investopedia +3, CBS News +3, The New Yorker +3. The comparison is not exact. Today's economies are more complex, global capital flows are deeper, central banks more powerful. And yet, the ghost of 1929 whispers in market corridors. The structural parallels, excessive debt, and leverage in 1929, speculative debt piled up. Margin loans expanded. Banks leveraged themselves. When asset prices turned, the debt collapsed on top of them. Wikipedia +2, Financial Times +2 Today. We see similar patterns: high corporate debt, an explosion in shadow banking, the proliferation of derivatives, and the belief that debt can endlessly fuel growth. Some analysts call this the perpetual money machine illusion. The idea that finance can indefinitely generate real wealth through leverage and financial engineering. So when that illusion hides fragile foundations. When growth slows, interest rates rise, or sentiment turns, the cascade begins. Deregulation and financial innovation. After World War I, financial markets were lightly regulated. New instruments appeared, sometimes opaque. In 1929, that opacity masked hidden liabilities and speculative excess. CBS News +3, Financial Times +3, The New Yorker +3 in our time. Fintech, crypto, peer-to-peer lending, special purpose vehicles, SPACs, algorithmic trading, all proliferate. Regulation has not always kept pace. Oversight is strained or deliberately loosened in some corridors. That trade-off cultivates systemic risk. Trade wars, protectionism, and global feedback. In the 1930s, governments desperate for revenue turned to protectionism. The Smoot-Hawley Tariff, 1930, triggered retaliation and a global collapse in trade. Global supply chains fractured. IFW Kiel, DE+1 today, geopolitical tension, currency wars, and trade conflict are rising. Some analysts warn of a drift toward 1930s-style protectionism. IFW Kiel.DE+2 PBS, Wisconsin +2. If global trade collapses again, the shock multiplier is immense. Weakening social safety nets and rising inequality in the interwar era. Inequality soared and vulnerable populations had limited recourse. The social fabric frayed. In the 2020s, inequality in many advanced economies has reached historical highs. Rising household debt, stagnant wages, and weak welfare systems leave many exposed. When a shock hits, it's not just markets, it's people. Unemployment, default, despair follow. The longer the crisis, the deeper the scars. Are we already sliding? Signs warning of recession are emerging. In Q1 2025, U.S. real GDP shrank by 0.3% versus prior growth of 2.4%. Mercatus Center +1. Some analysts warn we should be in recession watch mode. UCLA Anderson School of Management new machine learning tools assessing unemployment, vacancies, and other data suggest a 71% probability that the U.S. is already in recession. Archive still traditional measures hold firm. Many believe we are not yet in formal recession. NerdWallet. The lines blur, and therein lies the danger. A crisis often germinates in ambiguity before it erupts. Comparative charts aligning the 1929 crash and subsequent recoveries with later bear markets reveal something stark. The 1929 collapse remains the worst of the bad bears in terms of sustained impact. Advisor perspectives. Here's one. While each downturn is different, the echo pattern is clear, deep. Painful recoveries that test patience, trust, and resilience. The human pulse in crisis between statistics and charts lies reality. Millions lose jobs, homes, hope. In the 1930s, families migrated, children toiled, farmers abandoned fields, mass migrations reshaped states. Entire generations were scarred. Today, though social support systems are more advanced in many places, the human toll still looms. Defaults on loans surge. Small businesses shutter. Suicides rise, social trust unravels. The grief is quiet, often invisible. But it is real, and yet so is hope. Lessons not yet learned from 1929 came reforms. The Glass-Steagall Act, the Securities and Exchange Commission, the Federal Deposit Insurance Corporation, FDIC. The principle: regulate risk, protect depositors, and stabilize markets. Investopedia, +4, Financial Times +4, The New Yorker, +4, but since the 1980s, deregulation and financial innovation have pushed us toward re-risking that foundation. Archive +1. The belief that markets self-correct, that short memories save us, prevails in some quarters. But greed and complacency tend to overwrite caution. If we are to face this ghost, we must act preemptively. We must demand stronger oversight, enforce transparency, rebuild trust. We must rebuild financial resilience, not just at the macro level, but at the level of everyday lives. Strong safety nets, counter-cyclical policies, reform of tax and trade systems, even more, humility. The markets are not omniscient. Policies are not invincible. The future is uncertain. Final reflection. The ghost that teaches, the ghost of 1929, does not warn that history will repeat exactly. It warns that history rhymes. The same underlying human emotions, greed, fear, hubris, neglect, tend to cycle. The same structural risks, debt, leverage, opacity, inequality, persist. In our most dangerous moments, we forget that money, markets, wealth, they are constructs of faith and promise. When trust evaporates, they collapse. Yet we are not powerless. We can see the specter, name it, resist it. We can bend policy toward inclusion, oversight, prudence. We can build buffers. We can care for each other. If we learn from 1929 not by repeating it, but by outthinking it, then the ghost becomes a teacher. After all, the deepest question for any age is not whether the market will crash, but whether we are strong enough to weather it.